Wow. All right, so welcome. My name is Al Pickett. I am the author of the Blackprint, the founder of Blackprint, and essentially what the Blackprint is me teaching people how to gain leverage in this new world that we're in, and predominantly through the financial markets. I've been trading 16 years, and I've been coaching 6. It's been amazing. I'm enjoying myself, and I like to see people, just learn this skill. It's a skill. It's not this get rich thing. I'm going to talk about that too, but it is a skill that you learn and you develop. And in order to do this successfully, there's some things that you have to level up on. That's just the bottom line. Psychologically, mentally, financially, there's some things that you just have to do this at a high level. There's some things that you have to do internally that nobody else can do for you, and I'm going to share more about that. And this is also just an exposure thing, just exposing people to what's out there. What we've seen in the last couple of months, we saw COVID come, we saw that wreck the economy for what it's worth. We saw people shift and say, well, damn, now I never really thought about this before, but I need to be able to generate some income, just from a laptop or just wherever I'm at it in the world, because when the world stopped, everything stopped, right? The only things that were pretty much open were grocery stores. I think liquor stores, though. The liquor stores hardly ever close, right? So grocery stores, etc. So people had a wake-up call. And this is a wake-up call that I had. Again, this was well over a decade ago, just in terms of, okay, I need to be Amazon proof. I need to be let me say it first. I need to be recession proof first, which that the markets allow you to do that. And then I need to be Amazon proof. And Amazon proof now is like, hey, can Amazon come in and put you out of business, right? Amazon is not interested in the trading business as of yet. So those are some of the two things that I thought about many, many years ago. And I think now so many more people are catching on that, I need to figure this out. And everybody has the 401ks, but they don't necessarily know what's in it. They don't know how it works. They just know it's going up. They just know it's going down, and they know it's tied to the stock market. And when you really, really think about it, if you don't know, a lot of people are risk averse in terms of when they hear the stock market, they think it's risky, but they'll have their 401k tied to it, right? And not know anything about it, that's what's really risky. And so I've seen that over the years. When I was in real estate, I was in that business for a decade. And on the mortgage side, I'm looking at people's individual financial statements every single day and seeing what's really, really going on in this world. And from a behavioral finance standpoint, not much of that has changed, right? People get in over their head in terms of the debt, and don't really know much else about how to generate money. So we're going to break all that down. So first of all, let me talk about this. This is a conversation. It's not going to be a lot of, I'm going to get into charts. I'm going to get into technical things, but it's not this big, massive presentation. This is a conversation about, and me sharing everything. You can pretty much trade anything. Okay. So when people think about trading or investing, they think stocks. But the stocks are not, that's just the beginning, right? So you can trade stocks, Facebook, Twitter, Coca-Cola, whatever you want to do. And, you can do all of those, but you can also trade silver. You can also trade wheat. I have one client that only trades wheat, right? He's a farmer. His whole focus is wheat. He makes all of his money off of trading wheat. And everyday people doing the same thing. They just don't know that these instruments, you'll hear me use certain terms like financial instruments. They just don't know that these instruments are available to them to do this. But they are. Silver, platinum, what else? Oil, you can trade oil. You can trade interest rates. Bitcoin, I'm sure you all have, caught the whole rage of that. Some of you all may have got caught up when it tanked the last time. You're smarter about it this time. And you're going to learn some things here that'll help you make better decisions around that too. So the world is in the world of trading, it's wide open. but you don't need to try to trade everything. You need to find one thing or two things that you really, really like and focus on those, and that's going to help you be successful. Whether you decide to, hey, I want to trade for income. Some people trade for income, like I want to generate something every single month that allows me to maneuver. And some people trade for long-term, like wealth, which is what are my long-term investments doing, and so forth. And the only difference is time horizon. When we hear somebody say, hey, I'm a trader, or I'm an investor, the only difference is time horizon. Trader may be in a trade a couple minutes, a couple days. Investor may be in a position a couple months, a couple years. That's the only difference. The process, the thinking that goes into it, the risk management that goes into it is all the same. So, don't get hung up on terms in that way. Like, oh, I'm an investor, I'm in trade. It doesn't really matter. We're all trading time for something. So we're all traders at the end of the day. I'm going to talk about the difference between drop a 1 if you watch Bloomberg, CNBC, any news sites. If you have a news site that you watch, drop it in the chat. And I'm drinking my pomegranate juice. Very tasty. Carlos, you okay with being on Front Street? Because we got you all on the Front Street. Bloomberg, CNBC. CNBC. Okay. Cool. Okay. So if you could see my wall right now, you would see, my friends that know me, they know I don't own a TV. I haven't, and I don't remember the last time I owned a TV, but one of the reasons I got rid of it was because it's pretty much noise, right? When it's playing, what are they doing? They're getting you excited. You're seeing two colors. You're seeing red and green, and you have a relationship with these colors that you may not even subconsciously, you don't really realize how deep the relationship is that you have with these colors. So when you're watching, it's going red, green, and they're talking all excited, and this is going to do this, and this company is going to do this. It's all unnecessary. And so I'm hoping that by the end of this call, I convince you to turn off CNBC and Bloomberg. Because if the one question I ask people is, do they know anybody that made $2 or $3 million from watching Bloomberg or CNBC? And that just stops all the conversation, right? It's just entertainment, if the way that I see it, right? These colors, I want to talk about that piece because as we go into the rest of the evening, that's going to be important. So when you see red, when most people see red, even a red light, it's like, oh, it just kind of puts you on alert. It makes you stop. When you see red on a chart, on CNBC or Bloomberg, you're like, oh, it's bad. But it's not necessarily bad, because on those red days, I can guarantee you, if you're on the right, like there's somebody making money off of that. There's somebody making a lot of money on red days, right? That just means that if you see red like that, obviously it's the relationship, but it means you're on the wrong side of the market, because there's somebody that's seeing red and their eyes turning green, right? For what it's worth. But when you see green, right, that means go, and that means everything is good. You get these your endorphins start firing up, that kind of thing. And so you have to think about the tug of war that's happening with your emotions as you watch CNBC and Bloomberg. You're being pulled subconsciously, you don't know it. So that's another reason to just turn it off. And that also goes with just news in general. And I'm leading up to talking about what is the difference between fundamental and technical analysis. And so fundamental analysis is more like who's the CEO of the company? What new products do they have coming out? What is the economy doing? Who's the president? What's the harvest doing for oranges, right? These are fundamental things like, well, how's the weather and how's that going to affect crops, or how many gold mines are coming online, to whether, that's going to affect capacity of how much gold is going to be output and so forth. Those are fundamental things, right? But when you really look at the world and how large it is, it's large, but it's small. How do you get all the information? There's so much information. You can never get enough. You can read this, you can read every article and people have this problem where they're trying to, I understand the thinking is that you are trying to get a competitive edge using the information that's being provided by all of these different sources. And that's the fundamental aspect. The technical aspect is we're only looking at, for me, it's only looking at what the price is doing. So every instrument that I've talked about, whether it's gold, silver, stocks, currencies, commodities, and I didn't go back and talk about currencies, but commodities, etc., they all have one thing in common, and that's the price. That one thing in common is the price. It's the only objective information that's available at any given one time. It's the only information available at any given time, right? So the price is either, like once it prints, say oil, right? Say it's $30 a barrel. Well, if it was $30 a barrel yesterday, that's in the history, right? That is objective. That's exactly what it was the day before. If it's 36 today, it's 6:51 Central Time, that's very objective and factual. Excuse me. And we can draw a line through that data to be even more objective. But from a fundamental standpoint, people start looking and saying, well, I think it's going to do this because, these oil fields are shutting down, or, whatever the case. The difference between technical and fundamental at its core is, one is being subjective and one is being objective about what's really happening and about what could potentially happen. And so one, to me, is one about the fundamental approach is more you're handicapping, right? Oh, I think it may do this. Like this is 50-50 kind of thing. And since you're never going to be able to know all the information, why would you use anything that could be subjective? You want to use what's objective, what is factual, what's in history, what's in stone, because that is going to be more reliable. And what you're going to learn additionally tonight is that you can look at nothing but what the price is doing, right? What the price of an instrument, whether it's a stock, a currency, a commodity, a Bitcoin, you can look at nothing but what the price is doing and have a better chance of being successful than trying to watch all the news and so forth. So we talk about news, talk about fundamentals, and now I'm going to dive into, there's a couple of things I'm going to cover before we go into some of the strategy kind of things that I want everybody to understand. So now I'm going to share my screen. First of all, did that make sense? Was it helpful? Did you learn something? Do you have any questions before I move on to the next thing? Drop a one, don't be shy either. Ask the questions. Okay, cool. Close this. Okay, great. All right, I'm going to share my screen here. All right. Can everybody hear me okay? Everything all good? If you need to come off of mute to ask a question, I welcome that as well. I want this to be, active learning as well. So right now, I have CNBC pulled up, right? And when you see this, you know, again, I'm talking about the psychology of these colors. When you see this red, think that's bad, most people. And then here you say, oh man, today was a good day. It closed green. For somebody, it was a bad day. You know, perspective, you know, just perspective. Somebody, it was a bad day because, you know, they were looking for the market to go lower. And all across, you start to see, you know, these colors, and you associate these colors and words with good or bad. I'm trying to see what else I want to see. Okay. That's going to be something that is, you're not going to be able to unsee now that you've seen it. All right. So now I am going to talk about, remember where I talked about like these colors, and I'm going to talk about candlesticks. And we're just going to go right into, pull this up. I guess it needs to refresh here. And take a note of these sites as well, even though this is loading real slow right now. I don't know what's going on with the site. Take a note of these sites. This is finviz.com, Finviz. Finviz is a very, very powerful site. Market Watch is a powerful site. Yahoo is helpful too, but we're going to start with Finviz. We're going to do a lot of work here. So the first thing that I'm going to talk about is kind of how you're, you know, us looking at these charts. So everything happens. Remember these time frames that that we've talked about. Meaning, some people invest over a short amount of time. It may be weeks, it may be a day, it may be a month, it may be years. And what you see here is this. Here is daily. So what this is Nike, the company Nike. And each one of these little bars, these are called Japanese candlesticks for those of you that don't know. For those of you know, have some grace. For those who don't, we're going to walk through and explain what this means. So these candles represent what the price is actually doing. So we were talking about the price of Nike. Can you all see my whole screen, by the way? Okay, good. So this today it ended at $134.25, and you can see that it was down a little bit today. This is it was down 1.2, $1.29 or 1%, roughly 1%. But this red bar there, red candlestick, indicates the overall price for that day. Okay. This is going to be very, very important as we go forward. The green one represents that the previous day, that's the overall price, and it was up for that day, right? So you have red, and you can see going all the way back to June, that happens over and over and over. It just have price moving. And some days is up, some days is down. Some days is up, some days is down. But these are all representing each individual day. And I can guarantee you that, you know, no matter what happened on that day, somebody made some money, somebody lost some money, right? So whether you're a short-term or long-term, your portfolio went up or down depending on which way you were trading or investing in the market. And I need to talk about a concept that some may not be familiar with, that the reason I said that I can be, and the markets allows you to be recession proof, is because you can make money as the market falls. So even when you see these red candles like this, the term for it is called short selling. It's a little bit technical. It's a little tech heavy. I'm not going to go too much into that tonight, because I want to move through like the basic core understandings around everything else. But this is a market falling, right? So these red candlesticks mean the price was heavy this particular day, and there were people who were, if you will, betting. I'm using the term. I don't necessarily like to use that term, but it's easy for people to understand.
Al, there's a question.
Yeah. Okay. Yeah, it's raining here in Houston, so there may be a reason why this is moving a little slow, but we're gonna push through. Hold on. Let me see what question this is. Yeah, the question was, why are some candlesticks upside down? It's not that they're upside down, actually. The red ones is the price falling. So the red ones, do this. The red means the price is falling. So you see it's 134.25, and this is red. That just means that the price of Nike was falling for that particular day. So these are not upside down. This is just indicating what this, the green means the price was going up for that day, going up. The red means it's going down, right? And in that, this is how we find trends, which is what this is what we're going to go into next. So remember this piece. So even when the market is falling on whatever day, it could be, you know, like this was falling this particular day or today, people was able to profit from the market falling. It's, again, it's a bit tech heavy in terms of technical terms, but just know that people can make money from the market falling. And so before I continue, I want to make sure that makes, oh wait, let me come back. So there are terms for these candles. So the green ones would be known as bullish candlesticks. So that means buyers are coming into the market. This means that people are buying. When you see them green like that, it means people are buying. The red ones are known as bearish candlesticks. And when you see these, that means sellers are coming into the market. That means people are liquidating their shares. They're getting rid of their shares of that particular company. And the green ones means buyers, people are, or institutions are accumulating shares for those companies. So that's buyers and sellers, right? And that's bullish and bearish. So you may hear other terms. You may hear somebody say, well, I am long Nike. That just means that they are anticipating that the price is going to continue to rise in Nike. And you may hear somebody say, well, I'm short Nike. That means that person is, or institution is, anticipating that the price is going to continue to fall, and they're going to profit from it continuing to fall. So those are very important kind of technical things to remember, or, you know, definitions, if you will. But the green means the price is rising. Red means the price is falling. One is bullish, one is bearish. Drop a one if that. Go ahead.
Sorry.
Go ahead.
I think maybe she meant they look upside down because of the wicks.
Ah, I see. Yeah, yeah. That's yeah. We're not gonna go into the wick piece. We're gonna talk. Well, we'll cover the aspect of the wick on when we get to the other charts. Just in terms of open and close. But right now, I want to make sure that everybody understands green and red. These green, whether, you know, that one is bullish and one is bearish. One means the buyers are coming in, and one means the sellers are coming in. Can you drop a one if that makes sense? Great, 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 great. All right. All right. So the markets have this pattern that plays out over and over and over again. And this is one of the core things that I teach, which that allows people not to, what we're doing ultimately in technical analysis, not trying to predict what's going to happen. We're reacting to what's going to happen, or we're reacting to what's happening. We're reacting based on patterns. And I'm going to draw this on another, I'm going to draw this on it because I can't draw here. So I'm going to draw this here. Let me just delete all of this. All right. So the markets have this pattern that when something is, everything happens in trends. When there's an uptrend, ooh, my arrow is ugly. When something is an uptrend, it will move up, come down a little bit, and then continue to go up. And when something is in a downtrend, the price, when I say it, I'm referring to the price, will move down, come up a little bit, and continue to go down. Okay. This pattern is one of the most important things that I teach to begin with, because it just happens over and over and over. If you notice, I just came on, I just switched charts. And by the time we finish this, you're going to be able to identify a lot of this yourself. And so what I'm going to do now is I'm just going to show you, this is what we're looking at right now is the Dow. So this is an instrument that represents the Dow is what we're looking at. It's called US 30. But what I'm going to do is just point out this pattern that happens over and over, right? And remember that this is something to note, that the markets are dynamic, not static. The markets are dynamic, not static. And what I mean by that is, yes, there is a pattern that exists, but that pattern can happen over minutes. It can happen over hours. It can happen over days. It can happen over years. But the pattern is going to be what it's going to be, but it's not going to be the same every single time, meaning the same distance, the same percentage points of movement, and so forth. Excuse me. So what I mean by that, to further illustrate that, is the market goes up, comes down, goes up. So that's an uptrend, right? And at this point, the market went down, came up a little bit, came down. So it was in a little downtrend. And you can see probably little small little dips like that shows that this is a great example of it being dynamic. You get this red candle right here. It just shows that the sellers came in, but right after that, the buyers came in the day after that, the day after that, the day after that, and the day after that. So that's just kind of showing you an uptrend. And then you see this nice long drop, right? And then the market starts to go up a little bit more and continue to go up. And then this is kind of where we are right now. Drop a 1 if that simple illustration makes sense to you. Okay, so these patterns repeat over and over and over and over again. Rika, who is on the call, who is the other Blackprint trainer, coach, licensed Blackprint coach, the only other licensed Blackprint coach. This is something that she paid a whole lot of attention to. This is why she does what she does and as good as she is because she understands these patterns and accepts them for what they are. And so once you see this, you cannot unsee it. The point that I want to make here is once you see this, you can't unsee it. So you should be able to, after this Zoom, you'll be able to identify what's in an uptrend, what's in a downtrend just by looking at the charts. So now that I've gone over this a little bit here, I am going to pull up a couple of companies, and I want you all to drop in there in the comments and let me know whether it's in an uptrend or a downtrend. All right, so just by what you learned thus far, everything flows from the right to the left. When you're looking at these charts, everything flows from the right to the left. So this is the right side, this is the left side. This is all in the history. This is everything that's happening right now or happened today, all the way down to this candle. So if you were to look at this over this period of time, what would you say that Nike is in? Delete. Drawings. Okay, good. See, I mean, you're starting to see it real quick. See how quick that happens. So now I'm gonna pull up another. Nike is the only company that I picked. I didn't pick a whole bunch of companies, so I'm picking random companies so that we can see what's happening here together. All right, Christina, I see you. All right. So I'm going to do Facebook. It's moving so slow. Okay.
There was a question.
Thank you. Pull up Facebook here. Down. I don't see a. What was the question? Or is it?
It says, how is it upward if we're moving right to left?
So let me go back over here real quick. So slow. Pull Nike back up over here. Okay. So this is Nike again. So when I say right to left, this is the most important aspect of the chart. So this is the here and now, and this left side is all history. So if you're looking from, you start from over here, it's just a market going up, up, up. It's coming down a little bit here and there, up, up, up. But this is right now. So if you're looking at it, even from here to back here, you can identify that it's in an uptrend. You can do it from over everything in terms of right now, in terms of execution, in terms of trading, in terms of investing. All of that happens here. But when you're viewing the charts, you can look left or right, but the action and the execution, everything happens from the right side. Does that answer the question?
Yes, that answers my question.
Okay, great. All right. So I'm going to pull up. I'm probably just going to pull up because there's so much I want to cover. I'm going to pull up just a few more. So let's try Facebook here because everybody's on Facebook, right? Okay. So if you have to look at this chart, what kind of trend is Facebook in based on what you've learned? Up, down? Is it up, down? Some say sideways, some say down. Okay. Anybody else? That's it? Chad says both. Up. So this is basically an uptrend, right? If you notice, so you've seen you see it drop a little bit, but from here down, up, down, up, down, up, big drop down, but now it's starting to come back up, right? So it's just going back up. Now it has to go back above this point, but it hasn't. If you just look, look at the slope here, and you can see it's still in an uptrend. All right, one more. Anybody have a company they want to look at? I can pull one out of thin air, or I can look at one that you have in mind? Oh yeah, Tesla's a good one. It's a lot of people trading Tesla right now. All right, drop in there what do you think Tesla is doing? Up, 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 up. Okay, see, that's quick, right? And so you should, you know, besides the other one that was up, that was kind of hard for, you know, some of you all to tell, but you should be able to spot some of these companies now and tell whether it's in an uptrend, right? Versus what you think is going to do, what it might do. You should be able to pull these companies up, you know, after you hear about them or whatever the case, and, you know, kind of see what's going on with them. And what's in motion generally stays in motion. That's something to remember. So if something is in a downtrend, it generally stays in a downtrend for a certain amount of time. If you look at gas prices, that happens all the time. When they start going down, they usually go down for a while. When they start going up, they usually go up for a while. So what's in motion generally stays in motion in that direction. So as long as you get ahead of it before the news starts to talk about it. So if you notice, when we hit 30,000 and then we hit 19,000 again on Bitcoin, after that, they start to drop, right? So that is, you know, that's a selling event for people who bought a long time ago. And, you know, in the market, there's buyers and sellers. So whenever you are buying, somebody is selling that to you. And whenever you're selling, somebody else is buying it from you. So, you know, it balances itself out and you need both to play the game. So now that you're able to see that, what I'm going to dive into now is the moving averages, right? So these are so the candlesticks are very, very important. We're going to do some more work around that. But the next thing I'm going to talk about is the candlesticks. And I'm going to the moving averages. So the moving averages are essentially, you know, it's a strategy. It's tools that the professionals use to quickly identify. You're able to spot it with the candlesticks, but it's also a tool that professionals use to quickly identify what the market is doing and how it's moving. And I'm just going to add some on here, and I'm going to explain what they are and what they do. All right. So I'm going to add because this is one that a lot of big banks use. Where did it go? Just looking for it. There we go. Okay. And here we're going to add a change the color to green. And, all right. So I'm going to talk about these, what I just added to the screen. So these two, you will see a lot of, when you pull up a yahoo.com, you pull up a finviz.com, you pull up marketwatch.com, and you pull up their interactive charts, usually you're going to see a 20, a 50, and a 200 or something like that. And the reason that is because a lot of the institutional players use these moving averages. And what a moving average is just an average of the prices over a certain period of time. And what they do is just draw a line through the data. Ultimately, it's just a line through the data so that you can quickly assess, all right, what's happening in this market? Is it moving up or moving down? And so when you see this is a 20 moving average. So 20 means that it's looking at wherever this line is looking at the last 20 days. So this line being here, each one of these candlesticks representing a day and time. right? So 1, 2, basically 20 candlesticks back is looking at the last 20 days and is plotting a line up to this point. So what this does for professionals is to say, hey, this is in this market is in an uptrend. And when something is in an uptrend, you only want to be looking for buying opportunities, right? That means you should be accumulating shares or accumulating positions. I mean, you should be buying because the probability is that the market is going to continue to go up. And so if you look at this, this is going back to July of 2020. Remember, this is the Dow. And so long as this price was rising, the moving average was rising, it just kind of kept going up, kept going up, kept going up. Even when it dropped a little bit, the moving average, when it comes back above the moving average, price tends to come back up. Same thing over here. These candlesticks, when they start to go above that moving average, price starts to go up in that direction. So if you were to, so right now, the overall market is in an uptrend. So does that make sense? Does that explanation of what that moving average means and does and why is there, does it make sense? Drop a 1 for me. Good, good, good. Okay, so the blue line that you see down here is the 200-day moving average. This is very, very common amongst big hedge funds. So it's a 200, that means it's looking at the last 200 days and plotting a graph or plotting a line across it. And generally what, the wisdom is that so long as price is above this line, then we're still in an uptrend. But you can also look at the slope of the line to determine, okay, this is sloping up, this is continuing up. And that is an indication that the market is still going up in an upward direction and you want to be looking for buying opportunities, not selling opportunities, but buying opportunities. And when you combine these two together, right? So you have a 20 and a 100, what that does is give you a short-term look at what's happening and a long-term look what's happening. Okay, I know it's over the last 20 days. We're looking right here. The last 20 days, the market has been up. And if we're looking at here, then the last 200 days, the market has been up. So we want to continue to look for buying opportunities. So that's how we combine the moving averages to give us a complete look at what's happening. So short term it's moving up and long term it's moving up. Does that make sense to everybody? Okay, so this is something fun particularly to talk about that's not talked about a lot. Make sure there's no question. Okay, great. That makes plenty of sense to everybody. Cool. Okay, so first of all, let me back up. So using these moving averages. So if you wanted to pull up any stock or any currency, any commodity, you could apply these moving averages depending on the platform. We talked about FinViz. You can do that on finviz.com. You can do that on a lot of these free platforms where you add these moving averages to the platform. Now I want to talk about risk management, right? This piece right here is very critical because a lot of times when someone says, hey, well, you know what if one of the reasons why I started teaching was because I would see people buy stocks that were falling heavy. So stock starts to fall and people go, well, I'm gonna buy it because it's gotta come back up. And while we may not get into the all the absolutes of how to, because it's markets closed, we can't do a lot of technical things, but I want to talk about the thinking behind this, because this thinking will help you tremendously. When people say, well, it's got to come back up. Well, a stock can drop 20%, it can drop 30%, it can drop 40%, it could drop 50%, And, you know, the way I look at it is I don't care if it's $100. If I lose 50, if I invest $100 and I lose 50 of that, if I were looking at the $100 as one business, that $100 is one whole business. If I lose $50, that's 50% of my business. Would you want to lose 50% of your business in one transaction? Right? Would you want to stake 50% of your business on any one transaction and say, hey, if this don't work, I lose 50%. Right? And that's the way that a lot of people invest. They go, well, it's got to come back up. Well, not necessarily. It's companies that go out of business. I mean, look at Blockbuster, right? It's not a lot of them that go out of business like that once they hit the exchange. But the point is that you need to, the concept is risk management. So you may have an entry, but you also need to have an exit point that says, and these are the technical things that says, hey, if this drops by $5, I'm going to exit this, because you can always get back in. You don't want to be in wishing you was out. I'd rather be out wishing I was in than in wishing I was out. So you always want to have an idea of when you're going to cut the losses on a position, right? Because you can always get back in. But at no point do you want to risk losing 50% of your, $100 or, whatever the number is. Because say, for instance, this is a great example. Say, for instance, the market starts to go down and go down and go down. Well, now that once it starts to go back above a moving average or short-term moving average, you have a higher probability that it's going to continue in that direction. So now you're going to start to think about it differently. Like, okay, well, all right, that doesn't look like that's working. I'm going to go ahead and get out of it because I know I can get back in it once it starts to close above a certain moving average. Does that make sense for everybody? So you really it's like surfing. I mean, it's just like, okay, well, you're really just trying to catch the next wave. And if you're getting wiped out, you want to close out and then wait for the next wave. And that is, you can use the moving averages to do that. Okay, great. So let's see if I can do this now. This site is acting a little slow. It's giving me ads. So how do you know? Here we go. Drop a 1 if you heard of the concept or the term. If you ever heard somebody say, well, you just got to follow the money. Drop a 1. Okay, great. So not only are you being equipped with these tools, right? Those are strategies and tools that professionals use, that we use to get in the market, to determine when we should be getting in and when we should be getting out. But this is also public information. So notice I've clicked on the insider. This is on FinViz. This is also on yahoo.com. This is always public information. FinViz, Yahoo, MarketWatch, you can pull up the same information. But what this is it's telling you the presidents, the executives of these companies or large companies that own different percentages. It's telling you what they're doing with their stocks. Like if they're buying, if they're accumulating, it'll say buy. If they're selling, it'll say sell, right? And at that point, you can start to say, well, why are they selling? Right? Why are they selling? Is it in a downtrend? Is there an opportunity to be in that position, or why are they buying? Why is a particular CEO buying its shares, the shares of that company? Is it in an uptrend? Should I be buying as well from an objective standpoint? Because this is still objective information. This is something that took place. This is something that happened, right? Somebody sold and somebody bought. And you can use this information to your advantage to time and get a better idea when you should be accumulating or getting rid of a particular company. The way that I used this back in 2008, 2009 was very, very simple. I would look at, let's see if we can just go over here real quick. I would look at what the officers were doing with these companies. Like, were they buying, were they selling? How much was the share prices? And then how much cash did they have on the books? Buying and selling a company, how is that not unethical inside information? They have to report that information. They have to report, you know, that information to the SEC. So, you know, when you looked at, I forget what politician it was, right? But, you know, when COVID happened and one of the politicians, and him and his wife, I don't remember the names, but they had already had some information about it, and it came about that they had been selling their shares. And with that information, that's why that information has to be public, so that you can see if officers, senators. So if you have officers of those companies that did the same thing, but didn't, if they sold those shares first because they felt like it was going to be bad for the stock and did not tell the, didn't tell everybody else, then that's the term insider trading. That's where that comes from, and that's, basically those people go to jail. Okay, so let's pull up. Let's pull up Tesla, actually. No, let's pull up Amazon. Okay, so when you pull up a stock on yahoo.com, I like yahoo.com. This is exactly what I used in 2008, 2009. All the information is here: options, holders, financials, etc. So one of the first things I would do, and you know that Amazon is loaded, you can look at these companies' financials, and you don't have to have, like a crazy, some kind of crazy degree or in finance or business to do this. You're just looking at the balance sheet. You click on this balance sheet over here, and you can Google how to read a balance sheet if you want to dive deep into it. But what you're really, really looking at is, how much cash a company has. So they've got, this. All right. So here is their ending cash position. Last trailing 12 months, they basically had $38 billion in cash. At the end of 2019, they had $36 billion in cash. So probably not going out of business anytime soon. That makes sense. Like, you're gonna run through $38 billion in cash in a year? Probably not. So that's one of the things I would look at, is like, how much cash does a company have in their coffers? It's no different if you think about this as an individual and you say, well, how much cash do I have in the bank account?
Never been an update.
Hold on, whoever this is, let me mute this person that just came in.
The entire election.
There we go. Um, okay, so what I just clicked on was holders. And now it's showing you insider transactions. Insider purchases in the last 6 months. There have been 32 transactions at 269,000. There have been way more sales. 2 million shares have been sold. And it will go into detail to tell you who has been selling and at what, right? So this person's been, he's an officer, he's been selling, right? You can see how much, you can see the amount. Oh, we got a question down here. All right, and so you can go in here and you can see it just really, really direct information. People are selling. And when you start to see things like that, in particular, the way that I use this is at the end, when it was crazy, when people were freaking out, I was looking to see who was buying, not who was selling, right? And this information shows up publicly. If you go back and you look at March, you can see this past March, you can see which officers were buying. Excuse me, and that would have given you an indication. Okay, they have cash, they're buying. That means the prices were probably already depressed to some degree. And if you were just doing that alone and following the money, your chances are you're going to be on the right side of the trade. You're going to be on the right side of the transaction. And even if you don't, even if you didn't buy at the same time that they bought, you could then identify, hey, this is where they bought, and you apply the moving averages, and then that would give you an additional objective way to start to see when you should be accumulating shares. Does that make sense? Is that helpful? And you can pull up any of these companies, and you can kind of go through these you can go through their profiles. I'm not gonna go too crazy into doing that, but you can see it that way. Let me change this to everyone. Okay, so anyway, this was the number one thing that I used when I started. This was it. Just using, okay, well, who's buying, who's selling? Well, in this particular case, who's buying, how much cash do they have on the books, and can I follow the money, right? And I would take just a certain amount, whether that's a couple of thousand, whatever, and say, all right, I'm getting in here, I'm gonna buy here because I'm following the money. And that was as subjective as I got. And then I eliminated that process and started doing everything else that we talked about before. So with that being said, I'm going to dive a little bit deeper on the candlesticks to answer some of those questions. So what you're going to be able to do with this information going forward from where we came from to where we're going is now we're going to get into the details of how do you time, how do you know when you should be getting in? How do you know when you should be getting in? So that's where we're going now. Okay. So one of the questions, I think it was Stephanie who had the question, Rika, about why do the candlesticks look upside down?
It was Crystal.
Crystal, okay. So let's look at, I'm going to blow this up a little bit. So when you look at these candlesticks, let's talk about this one first. And this is going to be the education candle. And everything else will flow from there. So when you look at this candle, this is first of all, drop in the comments and tell me what kind of candle it is based on what we've talked about thus far. Okay, all right. Okay. So this is, like you all noted, this is a bullish candle. And what we're going to talk about is what makes up a candle. What makes a candle a candle? And this is how you're going to, this is additional information you're going to use to be able to identify when you should be getting into a particular trade. So this is what we call a wick. Wick. When you see this stick here, stick here, stick here, stick here, stick, 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 stick is a wick. The wick is a stick. And if you were to, the way I explain this to everybody is if I take you, if I have you in a helicopter and I let you land on the beach, or you parachute into a beach, right? And when you land, your body is there. So this is the body of the candle. If you walk to the left, you're going to leave footprints. If you walk to the right, you're going to leave footprints. And then if you come back to right where you landed, your body is going to be there. So the wick that you see here is nothing more than the distance that you traveled to the left or right and came back to a standing position, right? So this just means that price went that direction, but didn't stay there. Price went that direction, but didn't stay there. All right. And a candle, a candlestick is comprised of four things. So a high, a low, a open, and a close. That's something to know. A high, a open, a low, and a close. So on a bullish candle, the candle always opens at the bottom, right? So this is an opening. And remember, and this is something to remember as a note, all candlesticks, past and future, are connected to each other. So this candle is connected to this candle, is connected to this candle, and I'm going to show you why after we talk about high, low, and so forth. So this candle opened here. It traveled the price. When I say it, I'm referring to the price. The price traveled to this particular point and then came back. It also traveled down here, but didn't close there. So it may have opened here, it may have came all the way down here, it may have came all the way up here. Really doesn't matter. Either way, it traveled both distances. It opened here and then closed here. So a bullish candle opens at the bottom and closes at the top. That makes sense? Drop a 1. Got it. A bullish candle opens at the bottom, closes at the top. Okay, great. So the reverse is true for a bearish candle. A bearish candle opens at the top, closes at the bottom. So it's red, opens at the top, traveled all the way down, but didn't close there, came back here and closed at the bottom. And so the point of these candles being connected to each other, if we look at this candle, let's start over here. And I'm going to walk you all the way here, here, and here, okay? So this was a bullish candle. It closed at the top, right? Well, this was the start of the week, so let's start with this one. So this bullish candle here closed at the top. And then the next candle, what happened? This one opened here, came up here, came all the way up here, but didn't close there, but then closed here. And then what happened to this candle? This one opened, came all the way down, came all the way up, but closed here. And then what happened? The next candle opened, came back a little bit, closed here. And this is what we call this was a little indifferent because this is what we call a gap, not to be, it's a whole nother conversation. And so you have a bearish candle that closes down at the bottom. The market does its thing and then opens here, goes all the way up here, but doesn't close up there, closes here, a new candle forms, and now you all can see, or you should be able to see, or drop a 1 if that makes sense in context of every single candle being connected to each other. And understanding that the candle has 4 parts: high, low, open, and close. All right, all right, all right. Rika, you want to add anything to that?
No, I'm good.
Okay. All right. So now that we've identified that, this is a very, like what we just talked about is very, 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 very important, right? Outside of these moving averages, if you really, really focus on understanding the candles and what they're doing, and remember, these are daily candles. So this is a full day of going price moving up, buyers coming in, buyers coming in, buyers coming in, buyers coming in. Remember, now we're above this moving average. So there's a higher probability that the buyers are going to continue to come in. Excuse me. So once you start to see these things align and close above certain moving averages, then it's a higher probability that the price is going to continue in that direction versus guessing and saying, oh, I think it's going to go up, or I'm going to buy because it's low, or it dropped, or whatever the case. You can use these candles to identify areas where you can play the game, where you can enter the market. Any questions about that right now? How many of you all have some Bitcoin? If you've traded Bitcoin, you have some Bitcoin, maybe you have another cryptocurrency. If you have a cryptocurrency, let me know. Oops. Okay. Playcoin. Playcoin, no. One. XRP. Yes, yes, got it. Okay, cool. So what I'm going to do is I'm going to pull up, because we've talked about this a little bit. I just want to pull up the, as I plan to do, pull up the Bitcoin. As you can see, you see these different things. So these are currency pairs. I'm going to talk about that a little bit, so you all have an understanding. Oh, that's perfect. Perfect thing to talk about too. I'll talk about that after I go through cryptos real quick. Oh, wow. Look at that. Okay. Surprised Rika not smiling right now. So this is Bitcoin. So you all heard about it. You read about it. Some of you all own it, and you can see it's been going up. Let me delete these lines real quick. You can see it's been going up since October. It's much longer, but you can see it's been going up, 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 up. You see all these bullish candles? Now with your newfound knowledge, this is Bitcoin. No clue what it means. Well, oh, that's what I was hoping would happen with this call, is that we get things like, oh man, I have no clue what that means, or you have different questions, etc. Because I want it to be interactive. I don't want to just talk the whole time. I'll talk like 75% of the time and then have questions. But to me, crypto is nothing more. It's just another instrument, and I think it would behoove you to see it the same way. It's just another instrument that's tradable on the financial exchanges, right? When people start to like, and I look at like a Facebook stock the same way, or a Twitter stock the same way, or whatever it is the same way. It's just an instrument for me to trade, right, for a certain amount of time. Let me let these people in. So it's just an instrument for me to trade. I am not married to the concept. An instrument is only good as the confidence that the people have in it. So if you gave me right now, if you gave me 20,000 in Mexican pesos, where am I going to spend it in America? Pretty much nowhere. Nobody has confidence in the Mexican peso in the U.S. and not in the United States. You know, you might be able to keep yourself warm in the winter, but that's about it. So it's the same thing for Bitcoin. It's the same thing for every other instrument. It's only good as the confidence that people have in it. So otherwise, I'm not married to the concept. I'm not married. It's just a trade. It's just an instrument to trade. So anyway, I'm going to get to the point I'm trying to make. Notice that you see the moving average here. You see a 20. This is the 20 that we talked about. What is it doing? It's rising. So this moving average is telling you the price is continuing to go up. This bottom one here, this is a 200. It's clearly saying, hey, this thing is in an uptrend. You should only be looking to buy Bitcoin over here. We'll get into all of that. But what you've learned thus far is you start to see these bullish candles, bullish candles, bullish candles. How you identify when there may be a buying opportunity coming up is when you start to see bearish candles get close to the moving averages, like you see here, right? You see that the bearish candles, the red candles, let's call them red. You see the red candles. This is what we call a market pulling back in an uptrend. And remember that this is the pattern. I'm just drawing it out. See how clear that is? So my eyes, and I'm hoping that your eyes will tune in too, but my eyes are attuned to this pattern. I just see it everywhere I go. Doesn't matter, you know, what the chart is, what the instrument is, you should be able to see it and say, okay, well, based on this, probably should be buying. I don't have to know who invented Bitcoin. I don't have to know who Satoshi and all these different people are. I don't have to know what it's going to do next. I just have to say, okay, is it in an uptrend, or should I be buying or should I be selling? That's the only thing I'm concerned with every single day. I was going to go somewhere else with that. Oh, the other one was XRP that somebody pulled up. I think that was you, Abby.
Yep.
Okay, XRP. All right, so this is another one. See how crazy that is? It's just been up, 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 up. So now it's coming down, down, down. And it looks like it's going to present a new buying opportunity, because now you're starting to get some bullish, you're starting to get bullish candles. That means there are buyers coming in, buyers are coming in. So if you were going to look to buy, this would be this is education only, by the way. This is not an endorsement that you should be buying any of these right now, because you still need to know what risk management and so forth. But the buyers are coming into this particular market, which means that it has a higher probability of continuing to go up. All right. So that's XRP, that's Bitcoin. I wanted to expose you all to that so that it's not this frightening thing. So when you hear people talk about it, yeah, you can just say, let me think of a company. Well, somebody said something about GE or one of those companies. Danielle, you raised your hand. Give me 1 second. Somebody said something about GE. I don't even know who the CEO, I don't know who the CEO of Nike is. I have no idea how many warehouses, how many employees they have. I don't know what the next Air Max is that's coming out that's hot. I have no idea when the trains are running for the Jordans. It does not matter. It's in an uptrend. That's all I need to know. That's all you need to know. So I'm sharing that because it's the same way with Bitcoin. It's the same way with XRP, is that you identify which direction the market is going and you say, hey, I am going to risk $100 on this. And hey, if it gets, we're going to have to come back to that. We'll come back to that point. But the point is, you don't have to know everything about it to trade it, but you do have to understand these concepts. All right, Danielle, you raised your hand for a question.
Yes, good evening. Can you elaborate on the the candles. So also you mentioned that the bull candle opens at the bottom, the bear opens at the bottom. If I see wicks on both sides, can you kind of elaborate more on the concept of?
Yeah, like this right here, this
Yeah,
candle. Yeah.
yes.
So let's talk about that really quickly, and then from there, I'm going to move into Forex land after this. We'll talk about that a little bit. So this candle is a bullish candle because it's green, right? All this means, let me zoom in. This means that the price, remember that when it's a bullish candle, it opens at the bottom and closes at the top. So this is the opening, that's the closing at the top. Maybe let's use, that's a very wide one. So let's talk about it here because it's easier for people to see, or even this one. It opened at the bottom, closed at the top. But while it opened here, it traveled when it was open. Bitcoin's open right now. We may be able to see something like that. That's maybe very good for you all to see it on a 1 minute chart. But while it opened here, it traveled down here and it traveled up here. It just didn't stay in those places. Again, it opened here, traveled here. So it may have been red at this point, but it didn't stay red. And then it went all the way up, but didn't stay there, and it closed here. So this leaves what we call a wick. A wick here is just footprints in the sand. Go ahead, you had a question? Okay, all right, good. Ebony, yes, you can manage options in the same manner. I don't do anything with options, but you can manage options in the same manner. And what I mean by that is if you see something, if you use this, what you're learning now, and to identify what's in an uptrend, then you can identify on your options, hey, I should be doing a call option. I should be buying and looking at you're anticipating the price rising on the option. So you can use this same set of instruments, tools, and understanding to better price your options. Let me go over here and see if Bitcoin is one of the few things that you can trade on the weekend. So what we're going to do is we're going to spend 2 minutes watching what happens here. Just 2 minutes. So this candle is about to close. This is a 1 minute chart. This candle is about to close. It closed a bearish candle. Now you see how this candle just opened, right? And it's moving down. So now we're gonna see how this candle closes. Let me see. Had a question. Oh, y'all getting the bonus tonight. You get to see some live. Yes, it is definitely universal. Now you see how this candle is going up. It's going up, and see now you see the wick. That is the candle forming the wick. That's how a wick is formed, is when the price moves up like that but doesn't stay there. It starts to come back down again. See how it's coming down? And this is probably going to go red candle. So now you have a wick. We have 14 seconds, 13 seconds before this closes. This is a 1 minute chart. Bitcoin is pretty much the only thing that you can watch on the weekend or this time of day. So now you see how it went all the way up and it was green. Now we have a new candle that's about to open. Look how it opened. And now it's pushing down. And these candles form all the same way. And this is particularly what I look for. Like, this is what I'm looking at, because this is very objective. This is the real data. This is the real objective data, This is something that happened. It's stuck. It cannot change. And I can make decisions around that from an objective standpoint. Now my question really is, now that you all are seeing these wicks and seeing these candles move, is it making more sense of what they do and what, like how that, like the open, the close, the high, and the low? I'm glad we're talking about Bitcoin, because I didn't think about that, to look at this in a live environment in this particular way. See how that one formed? It went all the way down. This one was red at first, but then it turned green, and now it left a wick, and a new candle opens, and it just does the same thing over and over and over and over. Hey, all right, okay. All right. That makes me happy, by the way. Now look at it, it's like red, 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 red. So now I'm gonna talk about the Forex side of things. So in the last year, 2 years, Forex has, foreign exchange has pretty much exploded onto the scene, kind of, but no, not really. I mean, it's something I've been doing for 16 years. It became very, very popular, crazy popular when COVID kicked off, right? Because people were looking for a way to make some money. But one of the things that has happened more recently is you start to see these multi-level marketing companies. They started recruiting college kids because they could pay, they were gullible basically. Like, oh man, I want to make some money, I want to get rich. And just basically tell them all you have to do is plug in this and plug in that. And as you all can see, there's a lot more to do and understand than just plugging some numbers in. You need to know what you're doing to do this at a high level and to be successful. It's not just plug and play. There is no such thing as get rich quick in this business. Get rich slow, yeah, but not get rich quick. It just does not happen that way because you're acquiring a skill. You're not. It's a skill. Is exactly what it is. So Forex itself is $5+ trillion floating around per day, and every transaction that you're doing already is in those flows. So you're traveling to Mexico, the Mexican peso has to be exchanged and those kind of things, whether it's Europe, the African rand, everything from the African rand to the Japanese yen to the British pound. All of that money is flowing around the world all day, every day. Multinational organizations, institutions, governments, individuals, banks, so forth are causing those fluctuations in the market. And the confidence that people have in a country or whatever the case is causing these flows. None of that really matters to us right now. The only thing that matters to us is how do we identify what's going up and how do we identify what's going down? So I'm going to go over to Forex. I'm just going to pull up a currency pair and explain to you how to understand what's happening and give you some context. So again, this is Bitcoin. We're watching these candles. These are 1 minute candles. You're watching the, wow, it went up, came down, didn't close right at the bottom, closed right here. A new candle opens and it just repeats over and over and over and over and over. So something else that you all should learn if you're considering this business, if it's something that you really want to do, is support and resistance. We're not going to talk much about that tonight. I'm going to give you the concept and give you an abstract concept, and it's something that you can continue to learn. So support and resistance, also known as levels of interest, and this is applicable to any financial instrument. So I know I'm going to currencies, but you can apply it to that. You can apply it to Bitcoin. You can apply it to anything that's tradable. All it's saying is that, hey, this is support. This is an area that's being supported by new buyers. It's just looking at the past and saying, hey, what areas did buyers come in before? They came in here. Okay, well, since they came in here, there's a probability and a possibility that, this is only going to go so low and then continue to turn around. Or if it was up here, then it's only so high that it's going to go before it starts to turn around. So support and resistance. So the resistance is at the top. That means it's forming a ceiling. Sorry, let me just do something like that. It's forming a ceiling. And this is actually a great example. So this would be support. So that means it's finding support. That means an area that buyers are coming in. Same thing here, buyers are coming in. And then here you see that support being broken, right? And now this becomes resistance. And so it's just that's the abstract concept, but it's very, very powerful and something that we use to identify how much we can make on a trade, when we should enter a trade, and so forth. So very, very powerful. And I suggest, if you're going to do this business and, learn about trading, investing, whatever the case, is something you should definitely understand. Okay. So, all right, let me just take a quick second. Is this helpful? Were the candlesticks helpful? Are you learning? You having any aha moments? Have any questions right now before we move on? Great, 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 great. That's good. That's good. All right, so look at this right here. What's happening? So this, remember what I said? It's broke below that, and now this has become resistant. So now the question is whether this is going to start to go back above and continue to move, or is it going to fall from here? You've got 4 seconds here, so might as well watch it. Okay, so it closed back above that area. Chances are it's going to continue to go up a little bit higher. But we're going to move on. We're not going to go into all of that. So I'm going to use something that everybody understands. And let's go, where's my train? Use something that everybody. Okay. All right. Thank you for helping me out. Let's see here. I don't see the question.
It was to me. It says, what was the point about when a candlestick hits one of the running averages? I guess one of the moving averages.
Perfect opportunity to talk about that as we move into currencies. So, that's gorgeous. So this is the 20. So this is the 20 moving average. Very, very powerful lessons that I'm about to talk about. So this is the Euro US dollar. We're looking at the daily charts. So Euro, US, EUR, Euro, USD daily. Daily chart means each one of these candles is representing a day in time. Each one of these is representing a day in time. This platform that we're using is called MetaTrader, by the way. So the MetaTrader is pretty much something that all traders use for currencies, index, like stock indexes, even stocks, commodities, and so forth. You can trade pretty much anything on it. But all it is a software that you download from a broker. There are all kinds of brokers all around the world. There's some there's some brokers here that offer MetaTrader is the name of it. It's just software that you download. It doesn't cost anything. So that's what I'm using. What the software does is link into your broker, like whoever my broker is, say like, to give you an example, say Charles Schwab. What it does is go into Charles Schwab servers and allows me to transact my money. That's it. So it's software that allows you to link into a broker servers and transact your money, trade your money. So it's very, very popular, very common, and very easy to use. We won't be able to do a whole bunch on that tonight, but I just want you to understand what you're seeing. So Euro US dollar. So whenever you are looking at a currency pair, you're looking at, I don't want to make this confusing, but on the Forex side of things, you're always looking at a pair. You're looking at two things always. So this is Euro and the US dollar, or we may be looking at, let me just go over here. We may be looking at the US dollar and the Swiss franc, or the British pound and the US dollar, and the US dollar and the Japanese yen, or the US dollar and the Canadian dollar. You're always going to have two currency pairs together. And the one in the front is the dominant one. So British pound, if it's in the front, it's the dominant one. So Euro US dollar, it's the dominant one. And when you're buying one, you're simultaneously selling the other. That's even when I'm training people, I don't really talk about that because they get what I try to get down to is how do you execute? How do you know when to buy and when to sell? And then this automatically makes sense after. But when you're buying one, you're simultaneously. So if I'm buying the euro, what's happening in the back end is I'm simultaneously selling the dollar. If I'm buying the dollar, I'm simultaneously, if I'm buying the dollar, then I'm simultaneously selling the euro. And all that means is if I'm buying the dollar, that means this price is going down. This is in a downtrend and I'm buying, and the euro is losing value. But right now, the way you see this, the euro is gaining value and the dollar is losing value. Does that make sense? Drop a 1 if that makes sense. You absolutely get to choose the pairs, just like I just did. But what's important about choosing the pairs is, I'm looking at Rico on this. What's important about choosing the pairs is because you want a pair that, Chad, does 2 mean you need more understanding? And just drop another 2 if so. You want to trade something that is moving, right? If you cannot, you don't want, if you're trying to go somewhere, you don't want to be in still water, right? So if it's not moving, there are no waves. If there are no waves, ain't gonna be no waves in your bank account. So that's the point about like, you can pick whatever you want to pick, but you want to look at currency pairs that move a lot. Now, when you're just learning, you want to look at currency pairs maybe that don't move a lot, because it's going to allow you to see those little ripples. It's going to allow you to trade the ripples and be consistent. And if that makes sense, it's going to allow you to see things in a slower, like slow motion, almost like you're in the Matrix. Like, okay, I see what's happening here. Versus if it's moving like that, you may not be able to catch a wave, right? Because you need to learn how to surf a little bit. So, so Chad, again, the euro, when you see, it's a currency pair. The one on the front is the dominant one, excuse me. And when the price is going up, you're buying one. You're buying the euro. So if we were looking right now, we would be buying the euro. What's happening in the back end, it means we're selling dollars, right? So it's just a button. Really, it's just a button. That's the thing I try to get people to think about, is like, don't think about all the trends, like the big, maybe what's complicated on the happening underneath. But yeah, the price is going up. I need to go north. I need to get to DC. So I need to go north. That means I'm buying the euro. That's all I need to know for the most part. But what's happening underneath is you are selling the dollar. That just means if we were looking at fundamentals, the European euro would be gaining strength, which means it would just have much more buying power over the dollar. Does that make sense? I think I'll stop there so that everybody can catch that. Okay, great. Okay, so now to the thank you for hanging in there. I figured this was going to be about 2 hours anyway, so this is perfect. What I'm about to share is very, very powerful in the context of what was asked about the moving averages. So notice this is a 20 moving average. Doesn't matter let's assume we don't even know what instrument this is. We don't even know we're trading a euro. We just trading something. We haven't, think about it. We haven't even looked at what the price is. Like, oh, what is the actual price of the thing? We haven't even looked at that and talked much about that. We're talking about like real strategic, concrete things you need to understand to be able to do this at a high level. All of this is just kind of optics, if you will, the rest. And so let's talk about here. This is a bullish candle. It opened here, it closed here, it left it traveled that way. Most importantly, it closed above the moving average. Can everybody see that? Very, very important what we're about to talk about now. No, that is what a lot of people use for 20 moving average. Sometimes I don't even use moving averages because I understand the candlesticks. Okay, so everybody can see that. That's very good. Cool. So you get this bullish. What happens? Bearish. Remember what I said about when the price gets close to the moving averages? It's time for you. It's time for you to start to go, okay, well, maybe a buying opportunity is coming, right? Maybe a buying opportunity is coming, but we want to, well, what if we want more confirmation? We don't want to just, oh, it's going down, we should buy, because we don't know how low it can go. Look at this area and look at what happened here. So, we call it catching falling knives. We don't want to catch a falling knife. So market's coming down, we like, oh, we're gonna buy it because it's coming to the moving average. It's gotta bounce. Well, guess what happens? It just keeps going. Now you're panicking, you're freaking out. There are 4 things that every single trader has to deal with, investor, trader, whatever you want to call yourself. You have to deal with fear, greed, hope, and regret, right? And what happens in this situation is you buy hoping that it's the bottom, and then it starts to go down. Now you're hoping that it turns around. You're fearful that you're going to take a loss, and you don't want to, like, oh, well, I'm just going to hold on to it. You're fearful to close the trade, right? Yeah, so those things are mentally, those are the things that are happening that prevent you from taking action, because you really don't have any rules on what gets me out, what gets me in. Think about it this way. You playing this game, whether you're an investor or a trader, whatever it is, you're playing this game with the best in the world. The best in the world. So if you go into it and you don't have a plan, you got a hunch, you have an intuition, you're going to get your ass kicked a lot. You can get lucky. And it's people who, like, when Chris, I think you're on the line, but something you posted about how many gurus and investing gurus are going to come out. Anybody could have made money this year. Anybody could have made money this year. But what separates that is like being able to throw a dart when everything is good is how do you navigate and how do you make those same moves? How do you profit when the market is falling? That is the difference, right? And so that's where that's where these concepts that I'm covering are very, very important. So again, you don't want to catch the falling knife. I'm talking about this area because I don't want you to be in this situation. I want you to be able to say, okay, maybe it's time for us to be looking to buy. Now let's talk about what happened with this candle. It opened here, came up here a little bit, came all the way down, but it didn't close there. Where did it close? It closed right here. And where is that? Above the 20 moving average. So what's happened, what we call that is it's respecting that moving average. It did not close below. Look what happened when this price closed below this moving average. What happened? It continued to fall. But this one said, no, I respect it. I'm gonna stop right here. But then what happens? So you get a new candle that opens, and it came down a little bit, but it didn't stay there. It came up and it stopped right here. Now we have a bullish candle. So this is a perfect scenario to be looking to buy, because we had it's closing out, everything is closing above the 20 moving average. We have price that came down and says, hey, I respect this. Then we get a confirmation that more buyers are coming into the market. And that process, that knowledge base right there can be used for Bitcoin, currencies, commodities, whatever. Just that concept alone with what you learned tonight, like, okay, moving average, candlesticks, when the price starts to get close to the moving averages, is it respecting the moving averages? Are buyers coming in? And we can identify that very objectively. This is the last piece. The last piece is risk management, which is very, very important. Very, very important. I'm going to take this 10 minutes to talk about this, but not even 10. But this scenario, let's talk about these two scenarios. If I say I have $10,000. I have $10,000 that I'm trading, and I'm going to risk 200 of that 10,000. That's all I want to risk. It's 200. I don't want to risk 5,000. I want to risk 200. So what I'm going to do is I'm going to use this terminology in a way that I think everybody can understand and relate to. I'm going to buy $200 worth of shares once this shows me that it respects this area, right? Or I'm going to buy enough shares that represent, that if I'm wrong about this, I only lose $200. Okay. So I'm getting in here. This is a concept I want you all to look up and study. It's called a stop loss. Stop loss means that I need to stop losing at this point, right? And when you go on Facebook and then the market start moving again, you're gonna hear people say, "Well, I'm gonna get in right. I'm gonna buy right here because it's falling." All you have to do is say, "Well, where do you get out?" Right? Where do you get out? And people won't be able to tell you. That's what a stop loss does. A stop loss tells you, "Hey, I'm out because if I lose $200 here, then that trade probably wasn't going to work in the first place, and I'll wait for another opportunity." And the power of doing that is say, I'm going to risk $200 here. Let me give you this example. So if, say, for instance, I bought here, right? And boom, it comes down, it takes my $200. Out of my 10,000, I go over here, I do that same thing again. All right, I'm risking $200. If it comes down here, I'm out, I'm going to lose 200. But then it ends up going up over here and I made 1,000. Does that make sense? So you're really just running a bunch of experiments, right? When you have this information, you're running experiments to say, hey, if this goes below this and closes below this, I'm closing that trade because I don't want to endure this. I'm not gonna let my fear, greed, hope, and regret get the best of me and me stay into this, and it can continue to go further. I'm not gonna do that. And then I get a chance to play another day. So you stay in this and then you lose 1,000 of that 10,000. Well, now you just said break even. If this actually works out, you just said break even. However, if you just close this out and you say, all right, that's a wash. And then this one, now you're up $800. And that is the very, 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 very important difference between somebody who makes money doing this and somebody who does not. Is, people who don't, they let their losers get, they don't have a process, they don't have correct thinking, and they let their losers get the best of them. And then the other people are willing to cut those really fast. That makes sense. You sent this message privately, so I'm going to read it. That makes sense. Is that a place to wait for opportunity to move in and take a trade? What other strategies could I use to identify opportunity? That's a conversation we can have offline because I want to keep it to where everybody can understand and all of these things flow together. I wanted everything to be the way I did this and the way I wrote it, the way I put it together was just so that it could all come together by the time we end and it makes sense. And then you can further, this is not the stop. You can further your education from here, learning about these concepts that you heard. You can go back and you can look at the different charts and just spend some time doing that. And you'd be surprised how much, just even from tonight, you're gonna be surprised how much more you're able to look at things from an objective standpoint and at least have a better idea of what to do. Now that we know when to buy, when should we sell? Well, so this concept, this right here, right? Remember how this is respect. Oh, let me finish this. So this respected this area, and you bought over here. What happened? Price came back down again. Let's talk about this bearish candlestick. This is the body. This means that it opened here. Remember, it's a red candlestick. It opens at the top, closes at the bottom. And everything else was where it traveled to. So it opened here. It may have went all the way up, didn't stay there. Went all the way down, didn't stay there. So whenever you see a wick like this, a wick like that on a moving average, and it does that, it's respecting that moving average. This just means that buyers are coming in and saying, nope, we're not done yet. Buyers are coming in and saying, nope, we're not done yet. Buyers are coming in saying, nope, we're not done yet. This is an area where the sellers overpower the buyers. So how do you know when you are selling or when you should get out of a position? It's a more detailed, there's a little bit more nuance to it, but the concept is once it starts to break down and close below certain moving averages, that is okay to say, all right, I'm gonna cut this one short, I'll find another one. Market's going, then let me say this, markets are going to market. They're gonna keep marketing, and there's always gonna be a new opportunity. There's always gonna be another opportunity. So you don't have to think that it's gonna be the last one. Sometimes, people get FOMO. Remember when Bitcoin was at 20, then it dropped to 3,800? There was another opportunity after that. Same thing with stocks. For long-term investments, would you pull out, watch, and put back in stop loss? Yeah, even with long-term investments, you still want to have a plan. You still want to have a plan for when you're going to, okay, this isn't working. Whether it's you bought at 10 and it came down to 8, right? It came down to 8. Maybe you say, I'm going to cut it. But if it works, then it goes to 12 and 14 and 16. And okay, that's great. But every single time, the next time it goes to 12 and I say, I'm going to buy at 12 and it comes to 10, I'm going to cut it. I can cut it, but my downside is limited. My upside is unlimited every single time. That's the most important thing to think about. And so I don't believe in number one, I don't believe in buying hold forever. Companies go bankrupt. And once you start to see how this works and you start to do more a deeper dive, you're going to see opportunities that are just crazy where you're like, well, why would I hold that forever anyway? And the way the world is changing, things are changing so much faster. So if you get a stock and it runs 200, 300% or 30% or 40%, you can find another runner that's going to run 30, 40%. So at some point you got to take some gains off the table and pay yourself for the discipline, for the hard work, for the patience and all those different things. And you can compound in that way. But I don't believe in forever when it comes to stocks. You don't marry stocks, you date them. I'm gonna leave it at that. Okay, so I think that's all I have tonight. I think that's a really, really good stopping point. Do you have any questions? Was it helpful? I'm all ears. We got a couple minutes here, and I'm grateful for you all tuning in and listening to me talk about something I absolutely love and I'm passionate about. It's been my work for the past 16 years, and it's gonna stay that way until I leave here. Let's see. Okay. Very helpful, very helpful. Good. Any questions? Don't be scared to ask. Because usually what happens, I do something like this, even when I'm just training clients, people get shy and they're like, oh, well, they feel like there's no dumb question, right? Because if you don't know, you don't know. So ask now, and then somebody else may chime in. Rika may chime in and say, oh, well, you can think about this, you can think about that. And this is a very powerful thing to leverage brain power. So don't be shy to ask. Should you look at a trend 6 months? I mean, how long you should look at a trend? It just depends on your time horizon, how long you plan on staying in a position. But you want to have a process that says, hey, what might be an indication, candlesticks, that tells me that this particular trend is coming to an end, or I may consider reducing my position or closing out some. Next time we discuss tax penalties when pulling back. Yeah, or you mean when closing a position? Yeah, I can do that next time. What would be the best time frame for entries? That depends on you. That depends on you and your personality. The longer the time frame, the bigger the time frame, the better, the easier it's going to be for you to see. And that's that. And then when is the next session? I have no idea. Again, this is like, okay, all right, Black Friday's coming up. Well, we doing Blackprint Friday. So I'm not sure when the next one's going to be. Lorenzo, feel free to reach out to me. I don't mind my phone. Let me put my phone number in here. Just send me a text. 2853. The candles have the respect for how windows appear. That's a deeper question. No, I'm not a broker. I am not a broker. I'm just a trader. That's going to take some, Chad, I think the best thing for you to do is to just kind of pull up, like Google support and resistance trading, unless we have a conversation about it, and that'll give you more insight. Oh, we're going to talk about that. Maybe off subject, but what are your thoughts on what will happen with retirement accounts as we approach a new administration? A lot of volatility. I think a lot of volatility is going to be around for a long time, just because, you know, there's so many things that are happening globally, and things are shifting. Power is shifting. All these different things. Hey, volatility is good if you know what you're doing. So in terms of the administration, if the last administration and the one before that and the one before that was any indication that anything can happen. So you just want to be prepared to execute based on your knowledge base, and you know, protect yourself and protect your gains and get the gains and keep the gains growing. The Blackprint is essentially it's me teaching people, with Rika and I teaching people to trade the markets. It doesn't matter whether it's currencies, commodities, stocks. I mean, predominantly our people trade the Forex, right? But the skill set, the education is applicable to all the instruments. And it's a 20 module process to begin with. You go through the modules. And I was paying attention to who was paying attention to directions too, because see, you got to be able to follow some concrete rules to do this, right? But you go through these 20 modules, and the modules are designed to get a person up and rolling and knowing what to do. And thank you, Rika, and how to execute, when to execute. And that's just the beginning, right? Because, you know, there's a weekly trading plan, and there's one-on-one, unlimited one-on-one coaching. So that's how the Blackprint works. If you know, again, this wasn't a sales thing, but if you want to have more conversation about that, we can do that offline. But that's it. Trading in the Zone is an amazing book. It's for me, it's the Bible of psychology, the psychology Bible, if you will, for the thinking that goes into this. Again, every single person is going to deal with greed, fear, regret, and hope. And you've got to, you know, you may deal with one or the other at any given time, and or all four. And once you get a hold of those things, you can do this at a high level. Books you recommend for the reading. Okay. So you can't hear me. Can you hear me? Can you hear me, Rika?
I can hear you. Someone asked for other references. I guess maybe websites or books.
Oh, you can go to babypips.com. Babypips.com. I've got some free videos on the website. What else? Trading in the Zone is The Disciplined Trader. It's by the same guy. Yeah, so I would do all of that. I mean, when I'm recommending resources, it's always it's nothing that I haven't done. And again, the goal is to create a shorter distance between you and success, right? So I don't want like people just reading stuff just for the sake of reading because the title is good. No, I'm gonna recommend stuff that works. But that's it. All right. Any other questions? It's 8:34 Central. I'm gonna let you get back to your pecan pie, to your leftover turkey and whatnot, your beverages. Awesome, awesome, awesome. Thank you again for coming. Again, if you heard something that was helpful, tweet it, share it. I'm really, really appreciative of that. And pecan pie. I'm really appreciative of that, and I'm appreciative of you all taking the time out this evening, on this Friday evening. And more than happy to engage. Rika or myself are more than happy to engage further. All right. Have a wonderful evening and good weekend. And happy Blackprint Friday. Oh, stop that. Okay.